You've probably heard that ETFs are the simplest way to invest. But honestly, that simplicity is kind of a mask, and it hides a few common mistakes that can cost beginners thousands of dollars over time. So before you even think about hitting that buy button, you absolutely must understand these 10 rules.
I mean, on the surface, they all look the same, right? A ticker symbol, a price, a button. But what's actually inside, the engine that drives the fund, that's what separates a smart wealth building machine from, well, a financial landmine. Getting this right from the very start is everything.
All right, so let's just start with the absolute basics. What even is an ETF? I like to think of it as the ultimate toolkit for building your financial future. Okay, imagine you've got a basket. Now, instead of going out and trying to pick one single apple or one single orange, you just buy the entire basket in one click. That's pretty much what an ETF is. It's a collection of investments, stocks, bonds, whatever, all bundled together. So with just one purchase, you own a tiny piece of hundreds or even thousands of companies. You get instant diversification. You know, for decades, if you wanted to buy that basket, you had to go to a traditional money manager or a mutual fund. But then ETFs came along and just completely changed the game. They offer four huge advantages that put more control and, frankly, more of your own money back into your pocket. First up, and this is the big one, fees. I mean, this chart really says it all. That tiny little green bar, that's a typical ETF fee. The giant red bar, that's what a traditional advisor might charge you year after year. We're talking about fractions of a single percent versus 1, 2, or maybe even 3%. It's a huge difference. And you might think, oh, that's a small difference. But over time, it's like a financial earthquake. This is literally tens or even hundreds of thousands of dollars of your money that either stays in your account or goes into someone else's pocket. The choice is pretty stark. And it's not just about the fees. ETFs are totally transparent. You know exactly what you own every single day. They remove human bias because they're built on rules, not some manager's gut feeling, which, by the way, is why most pros can't even beat them. And for beginners, they're basically the ultimate set it and grow kind of tool. So, now that you get the power of ETFs, let's build on that. The first three rules are all about building a rock-solid foundation for everything else. Okay, rule number one, and this is probably the most important of all, you have to know the index. See, every single ETF is designed to track something, and that something is its whole mission.
So what's it tracking? Is it the 500 biggest US companies, the S&P 500? Is it the entire world stock market? Just tech stocks? Or maybe it's bonds? Your first, most critical decision is simply choosing what part of the economy you actually want to own a piece of.
All right, rule number two is super simple. Check the expense ratio. Just think of this as the tiny little annual price tag for owning the ETF. It's the fee they charge to keep things running. And even if two ETFs track the exact same thing, their fees can be different. So always, always go with the one that has the lower fee. Every little bit you save goes straight back to you. Okay, moving on to rule number three. You've got to understand the different categories because not all ETFs are created equal, and just lumping them all together, that's a classic rookie mistake. So, you've got your big, broad market ETFs for massive diversification, you've got sector ETFs to aim at specific industries, and bond ETFs for some stability. But then there's another category, one that's so dangerous for beginners, it honestly needs its own separate warning, which we'll get to in a bit. Okay, so our foundation is set. These next few rules are all about dodging those common traps that so many new investors fall into. Rule number 4, liquidity matters a lot. Now, this might sound technical, but it's really simple. It just means how easily can you buy or sell it. A fund with tons of trading volume is super liquid. You get a fair price instantly with what's called a tight spread. That's just the tiny gap between the buying and selling price. Think of a wide spread as a hidden fee you pay on every single trade. And rule number 5. Man, this is an old one for a reason. Past performance means absolutely nothing. It is so tempting to look at what was hot last year and just throw all your money at it. That's called chasing returns. Don't do it. It's a trap. It almost always means you're buying at the absolute peak right before the hype disappears. Patience always wins. Which brings us right to rule number 6. focus on the total return, not just the dividend. It's really easy to get tempted by an ETF that promises a huge dividend payment, but here's the thing. A super high yield can actually be a red flag that a company is in trouble. What really matters is the total return. That's the growth of the fund plus any dividends it pays out. Don't ignore the bigger picture.
Okay, I need you to really listen up for a second. This next rule is so important it gets its own section. And that's because this is, without a doubt, the biggest and most dangerous trap a new ETF investor can possibly fall into.
I am talking about leveraged ETFs. On the surface, they sound amazing, right? Like a cheat code for investing. They promise to double or even triple the return of an index. But here's the killer detail, hidden in the fine print. They do it on a daily basis. And that one little word, daily, it changes everything. Just look at how this daily reset can absolutely destroy your money. Let's say the market goes up 10% one day. Your 2x fund shoots up 20%. You're feeling like a genius. But then the next day, the market drops 10%. The index is almost back to where it started. Your leveraged fund, though, it loses 20% from that new, higher number, and now you're deep in the red. This is a devastating effect called compounding decay. So let me be as clear as I possibly can be. Leveraged ETFs are complex trading tools for pros doing short-term bets. They are not for long-term buy-and-hold investors, period. Full stop. Trying to use them for that is one of the fastest ways to just watch your money disappear. Okay, with that really important warning out of the way, let's bring it all home with our last 3 rules. These are all about getting into the right mindset for long-term success, which is really the secret sauce to building wealth with ETFs.
So rule number 8 is pretty simple. The holdings can and will change. Companies in an index are always shifting around, so don't be shocked if your ETF looks a little different over time. For rule number 9, please remember that taxes matter. ETFs are already pretty tax-friendly, but putting them inside a tax-advantaged account like an IRA, that's like putting your growth on hyperdrive. And finally, the golden rule, number 10. Time in the market will always beat trying to time the market.
And there you have it, 10 powerful rules that can take you from being a curious beginner to a confident, informed investor. That's your blueprint for success right there. Look, ETFs are incredibly powerful tools, but only if you actually understand how they work. Their simplicity is their best feature, but it can also be their biggest hidden danger.
But if you choose the right index, keep your fees crazy low, avoid all the unnecessary risks, and just focus on the long term, you can absolutely change your financial future.
It doesn't matter if you're saving for retirement, building a nest egg, or you're just getting started. ETFs really can make investing simple, transparent, and just incredibly effective. So master these 10 rules, be patient, and just let time and consistency do all the heavy lifting for you.